You hear us talk about whole life insurance designed for cash value accumulation all the time on this channel. But today we're going to talk about what makes a whole life insurance policy designed for cash value accumulation. And it comes down to one thing, the paid up additions rider. Hi, I'm Olivia Kirk.
I'm Tim Yurek. We're from Tier 1 Capital, and we're here to show you how to regain control of your money. If I had to pick one and only one feature of a whole life insurance policy designed for cash accumulation, hands down, it would be the paid up additions rider.
A whole life insurance contract is very efficient on its own. In essence, the cash value will continue to grow throughout the life of the contract. In fact, it's a promise by the insurance company to have a cash value equal to the death benefit at the age of maturity, which is typically age 100 or 121. But with these policies designed for cash value accumulation, we add on a rider. It's kind of a supercharger to build that cash value sooner. So you're able to utilize that contract as soon as possible for your major capital purchases.
And literally what you're doing, it's called a paid up additional insurance rider. So let's break that down. What you're really doing is buying a single premium paid up whole life insurance policy under the umbrella of the regular whole life insurance policy. So you're stuffing these paid up policies inside the structure or the chassis of a whole life policy.
I like to think about it as the whole life policy being the pool of money, and the paid up additions rider is dumping extra buckets of money into your big pool, right? How could we fill up that pool faster?
And keep this in mind, when you buy a paid up additions rider with a mutual insurance company, those paid up additions, those paid up policies literally earn more dividends. So that's the way you could increase or watch your dividend pot grow over time.
Exactly. And over time, you're earning interest on the amount of money that's within the whole life contract. Plus, we think of these paid up additions as the cash value component to build up that cash value even faster. So with the paid up additions, you have immediate access to 85 to 95% of that cash immediately for policy loan.
Again, we view things through the lens of you being in control of your money. So while the money is still in the policy and you're getting a collateralized loan against the equity of that policy, now you could have that money and deploy it somewhere else, knowing full well you're earning the same amount of interest and dividends inside that policy, assuming you purchase the policy with a non-direct recognition company.
With the whole life contract designed for cash value accumulation, we're building up that cash value early on in the contract. Like I said earlier, the whole life policy will naturally become efficient over time. But during the first 2, 3, 4, 5 years, there's not much cash value availability in a traditional whole life policy. So what do? We add on that paid up additions rider so you have immediate access to a chunk of cash to achieve your financial goals, whether it's paying off debt, saving up for cars, saving up for other major capital purchases, maybe vacations, maybe new appliances. We're building up that cash value early on in those first few years, and then we're dropping off that rider. We don't need it anymore. The policy is becoming efficient on its own, and we no longer need that paid up additions rider to carry us through and build that cash value. In fact, the whole life policy, the whole life contract on its own becomes more efficient by dropping off this rider after it's done its job.
I like to think of it that the key to a paid up additions rider is that it gives you flexibility to put more money into the policy without the premium commitment, because the paid up additions rider, again, is flexible. So you're not obligated to put that paid up additions premium in each year.
Well, that's certainly something to consider because that's something that holds a lot of people back from purchasing the whole life policy to begin with, that commitment going forward.
I mean, it's basic human fear, right? Fear of commitment. But no, seriously.
And running out of money.
But the key here is the paid up additions rider gives you some premium flexibility, and it doesn't commit you to making that amount of premium for the paid up additions rider for the rest of your life.
So how these policies are designed is you'll choose a premium for the first 7 to 10 years. And then after that paid up additions rider drops off, you'll have a much lower premium going forward, whether that be 10, 20, 30, 40 years into the future, a much more realistic, much more reasonable premium that's going to carry you through to the rest of your life.
Yeah, and the key is, even if you run out of cash flow before you get to that 7 or 10 year period, let's say you run out of cash flow in the third year, you don't have to put the paid up additions rider in. So again, that flexibility is really attractive to a lot of people. One of the things I really like about paid up additions is that they could be a lifesaver during bad times. Life is not a straight line. And we get these twists and turns and valleys. And when we have those situations, it's usually money that could pull us out. And if you had the foresight of adding a paid up additions rider to your policy, that could be a lifesaver to help you through some of the dark times and the bad times. And again, it all emanates from having access to capital.
All right. So using a whole life insurance policy as a place to store your emergency fund is a great thing to do. It's a great way to save for those emergencies because you're earning continuous compound interest within the policy. You also have the death benefit in case you die along the way. A lot of times people have that waiver of premium if they become disabled. But by building up that cash value early on, you're setting yourself up to have that emergency fund for when the unexpected happens.
And as we discussed in a previous video, adding paid up additions increases the amount of dividends you're going to get from the insurance company. So that's something, again, when you view things through the lens of control, you could literally control the amount of dividends you're going to get in the future by putting in more paid up additions. So all of this adds to the control, the flexibility, the safety, the lifesaver component of life insurance.
Right. And although dividends aren't guaranteed and we don't have direct impact on the amount of dividends that are being credited to our policy, it could certainly have a positive impact in the amount of cash value that we have built in within the policy and thus the amount of dividends that would be credited if they are credited by the insurance company. Right. If you'd like to learn more about paid up additions and designing a whole life insurance contract designed for cash value accumulation to put to use in your life, for your family, your business, and your situation, be sure to visit our website at tier1capital.com to schedule your free strategy session today. Also, if you like this video, be sure to give us a thumbs up and check out these two. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep. That really matters. We'll see you in the next one.